Guys, obviously, if you have checked out the agenda, we have David Bassanese from BetaShares. He's the chief economist at BetaShares. We've had him present to the IFBF both in person and on our Zoom calls before. We had him earlier this year present on what was going on out there, and I think it was either shortly before or shortly after the COVID thing hit, and it was very interesting to have that conversation. Now, there's a bit of time and space since that has occurred, and I'm very curious, David, to hear what you have to say to us today about what's going on in Australia and so forth.
Oh, great. Yeah, all right. So, yeah, great to be with you all. Yeah, obviously a lot's been happening. It's pretty tumultuous year. Certainly the most tumultuous financial market year in my career. So, look, I'll just share with you a few sort of slides that I think are interesting in terms of where we are in terms of the global economy and financial markets, and also the Australian economy. Firstly, big picture, this is the global PMI index. So it covers both services and manufacturing for all the major economies in the world. And as you can see, we had that major collapse earlier this year. The depth being, off the charts in terms of certainly compared to the past two global recessions in 01, 02, and obviously in 08, 09. But also, it's fair to say it's been a V-shaped recovery in those PMIs. They've bounced back into that Goldilocks zone, as I call it, 50 to 55. Not too strong, pretty quickly. So as of August, as you can see, we are back in that zone. Now, thing about these PMI indicators, that you see them in the media and reported on in terms of market news. I mean, just to be clear, these are, when this is above 50, it means that more than half of the survey, corporations think business is better than it was the previous month. So it's a relative comparison compared to how things were the previous month. So things have obviously been getting better gradually over that time. So now, more than half are saying things are better than they were the previous month, but it's still the case that if you look at other indicators, level of activity is still well below where we were pre-COVID, but nonetheless, on the upward trajectory at this stage rather than continuing to sink. That's a big difference. In fact, I'll just touch on that in a second. Just to go across so breaking that down by region, you can see most regions have recovered back into that, above 50 zone. The only real laggard there being Japan at this stage. So far, the recovery has been fairly broad-based. The US and Europe and Asia, and obviously China. China went into this downturn quicker than everyone else and got out of it quicker than most as well. But this is, I think, an interesting way to think about the downturn that we're in compared to history. And what I've got there is aggregate hours worked. It's a monthly series, comes from the labour market surveys. Now, the thing about all the labour market programs that have been going on where, people have basically been paid to retain an attachment to the labour force, so even though they're not technically working, they can be defined as employed in some countries. And also in other areas, we've seen people who have lost their jobs in Australia, for example, who because they're not actively looking for a job, they're basically, they've been on the unemployment. Well, A, they just don't think they can find a job, but B, they've not actively been looking for whatever reason. They're not counted as unemployed as well. So the traditional labour market measures are being heavily distorted at the moment, unemployment rates, employment growth. But one way to look at underlying activity is this aggregate weekly hours worked measure. And as you can see, previous downturns, you usually get around about a 5 to 10% decline in hours worked during recessions in the past. I've got the shaded areas there of past US recessions. And as you can see, typically in a downturn, it tends to gradually weaken over the course of a year or so, bottom out, and then gradually recover. Whereas this time, it's really off the charts in both the speed of the collapse. Within a couple of months, we were down 10% or so from where we were. And then I guess at this stage, at least, the speed of the recovery. Now, I've blown up the last few months in the bottom slide just to sort of get a bit more of a feel for the pace of that rebound. So initially, it was a V-shaped, nice rebound, but I guess the worry going forward, and this is maybe what markets are starting to worry about now, is that we have had a leveling off in that rate of improvement over the last few months. So that, it's certainly what initially looked like a V-shaped recovery is sort of petering out somewhat. Due to lingering social distancing restrictions, due to obviously a business caution in terms of not being able to plan that far ahead, and the legacy of still lingering high unemployment. But in terms of financial markets, I mean, unless we go back through those lows, unless we go back through April, this is a chart of the US measure of aggregate weekly hours worked against the share market. This is the Wilshire 5000. As you can see, the markets, at least in the last two recessions, have tended to bottom some months ahead of the bottom of aggregate weekly hours worked. So what's relevant is not so much when recessions in the US officially end. As you can see, the 01-02 recession, as defined by the NBER, there's a group in the US that define when we're in recession and when we're not in the US. The aggregate weekly hours work continued to decline for well after that recession ended, and that's why the share market took a while to eventually find a bottom. It was after the recession had ended. Similarly, in 08-09, you see the market did bottom some months before the aggregate weekly hours bottom. What does all that mean? Basically, this suggests that if the bottom is in place for aggregate weekly hours, as I think it is, it's probably fair to say the bottom for the market is in place. So we're less likely to sort of retest those March lows. But having said that, the markets never go up in a straight line, and there are some challenges ahead, and that's why I think we're currently going through a correction, which may have a little bit further to play out in the short term. Just some of the now, some of the issues to think about at the moment. I mean, why have we been able to recover? At the moment, why has it initially looked like a V-shaped recovery, and why markets rallied? I think ultimately this is the key issue: is that think back to March and April, where we did get a first wave of viruses. We had a major spike in deaths. We didn't know much about the virus at the time. And if you looked at the history of pandemics, they typically have had second and third waves. And so that was the reason for my caution, along with many others, is that, we may be reopening the economy, getting through the first wave, but if we do get a second wave, there's a risk that we need to go back into lockdown again. What we've seen is that we have clearly got a second wave. So these charts show you the rate of new cases in a few countries, the UK, Spain, even the US. But to date, what we haven't had is similar spike in death rates. Now, and even allowing for lags, people say, oh, there's a lag before cases convert into deaths. I mean, as you can see from these charts, even allowing for lags, deaths are still holding at a relatively low level compared to what we've seen in the past. So why is that? Some of the cases reflect just increased testing. There's more capacity to test people. And some of the initial cases that we got were really basically incredibly sick people turning up at hospitals seeking help. So, very critical cases, whereas a lot of the cases now are not as critical. And also and that's also partly because it's a younger cohort this time that is being affected. So the reality is that as we've learned more about the disease, that the death rate, I guess the lethality of it for the broader population is not as bad as feared. Now, obviously a big there's still a massive debate. Just look at Victoria in terms of, should you go in a hard lockdown and when? But the bottom line here is, so far at least, many countries are learning to live with the virus, so to speak, during this second wave. The UK, as I'm sure you know, recently imposed some new restrictions, not full lockdown, but basically encouraging people to work from home, and restricting the number of gatherings, the size of gatherings and whatnot. So we are at I guess, a potential precipice where, we could see new measures reintroduced in some of the European countries. What we do know is interest rates are going to stay very, very low for a very long time. This is just a chart of bond yields, policy rate expectations amongst many central banks. And again, in fact, what we've seen the last few weeks, and many central banks reiterating that even if as growth recovers, they're probably going to keep rates on hold for at least a year, if not longer, because there's still a legacy of high unemployment, which they think will take a while to overcome. And also inflation, which was already lower than they would like, has gotten even lower. So interest rate story, lower for longer, really is the ongoing situation there. Just wanted to touch on some other areas that I'm looking at. Firstly, just the whole issue of US equity valuation. So where is the market at the moment? You can see that the market has rebounded, and it's resulted in, as you can see on the first slide there, the price to earnings ratio at the recent peak got up to 22 times earnings. So a level we haven't seen since the dot-com bubble. But that was associated with a collapse in bond yields. So that if you look at the equity to bond yield gap, yes, it was at the low end of its 10-year range, but by historic standards, still not that, still arguably at a reasonable level. So this is the massive debate at the moment. What is equity? What is fair value for the equity market, given the reality that interest rates are going to stay so low? Now, the second slide there is just my very rough, PE versus interest rates over time, and you can see periods where the market has been, clearly overvalued and undervalued relative to where interest rates were at the moment. You can see where we were in March, the market bottom. We were under that line of best fit. With the pullback in the markets in recent weeks, the US market is now trading about 20 times earnings, which, funnily enough, is bang in line with what the line of best fit through those data points would suggest it should be, given that 10-year bond yields are only 0.7%. So yes, the P ratio is high by historic standards, but given where interest rates are, we may, need to get used to a PE ratio, around about these levels until such time as interest rates start to lift in a big way. So again, bottom line here, I'm not that uncomfortable with PE ratios where they are, because they're broadly in line with where the interest rate situation is. The other thing to look at is what's happening on the earnings front. This is a chart of forward earnings for the US, and as you can see, there's been earlier this year, there was a collapse in earnings expectations for so these lines are analyst expectations for earnings for each calendar year on a rolling monthly basis. And so they slashed their expectations for 2020 and 21 earlier this year. And the orange line there is forward earnings. So it's a weighted average of earnings for this year and next year, and the weight on next year's earnings basically increases as we get closer to that new year. Bottom line here is markets are still anticipating a big recovery in earnings next year, and they've held to that conviction over the last few months. So that black line, as you can see, is still well above the blue line. Now, if that holds, then forward earnings, which is that orange line, can continue to rise. Now, I've penciled in some further downgrades. I think markets are still overly optimistic, but even if you do pencil in some further downgrades, it's still consistent with that orange line rising, moderately over the next year, something like a 16% growth rate. So again, provided we get this ongoing recovery, the earnings story is starting to look, somewhat more constructive for markets. Look, the Australian situation, this is the evaluations in Australia. We're probably a little bit more expensive relative to where interest rates are. Fair value is about 18. At the moment, we're at 20. So we're above that line. And our earnings story is actually not as favourable. If you look at the situation for earnings in Australia, earnings are still continuing to be downgraded. There's no signs yet of any stabilisation there. And the big difference is that the big driver of the global story is still technology. Still looking at very good earnings growth out of the tech sector, albeit not as much as we thought 6 months ago. But Australia, mining has enjoyed an earnings upgrade, but the banks obviously, which are a big part of our market, have continued to weigh on the market. So we're a little bit expensive, and we're not getting the earnings upside to the extent that we're seeing globally at the moment. But again, if expectations hold at these levels, earnings should rise over the coming year. But I don't have any confidence that we won't get further earnings downgrades in our market at this point. So just putting that, I've got a sort of central case scenario for the US market there. If you allow for a modest increase in yields over the next year, the PE ratio coming down to around about 19, still high by historic standards, and some growth in forward earnings, you can get the market, holding at around 3,500 on a one-year basis. Doesn't give you a lot of upside, but nor does it suggest, we need to have a major crash in the markets either. So I think the bottom is in. We're in for this, you know, recovery period. I also think the, you know, globally, you know, more opportunities probably still exist in international markets. And this is a chart of performances up until August, end of August, across the different sectors. As you can see, tech, I mean, the big thing of COVID has been that the growth sectors that were doing well before the COVID crisis have actually happened to be the ones that have become defensive sectors during the crisis, i.e. technology, consumer discretionary to some extent, because it includes things like Amazon and whatnot, communications, includes Facebook these days. So tech, the big FANG stocks are sort of evident across a number of different global sectors at the moment. Obviously, tech is having a pullback at the moment. Probably went too far too fast in the short run, but on a one-year view, I'd still favour the growth areas. I'd still favour the tech areas globally versus, say, the more traditional value areas, which are, you know, financials and energy. I think bond yields are going to stay low. Oil prices are sort of capped, and also energy is facing a big structural change, of course, as a shift from fossil fuels. So I think there's some structural challenges for value parts of the market. So a lot of this, you know, people are saying growth versus value has just gone so far for so long. There's got to be a sort of switching. But I mean, a lot of it is it's a structural story. It's not a cyclical story, and so that's why I think a lot of people looking for that value rotation have been disappointed and may continue to be generally disappointed. I'll just conclude. I mean, a couple of areas. Gold has been doing well. If bond yields continue to hold at these levels, it certainly can continue to hold up relatively well. But it's a bond yield story. And now if the US Federal Reserve goes to more quantitative easing, it targets a certain bond yield. If the Fed feels the need to do more stimulus, and, you know, that's looking likely given the sort of tapering off in the growth story, that may give gold another leg along, which has had a bit of a correction at the moment, but it's really a bond yield story. The other thing I just wanted to highlight, of course, over the next few months will be the US election. And again, this is something the markets are starting to focus on at the moment. And I guess the two worst case scenarios for the market are something like 2000 and 2008. In 2000, obviously, we had a disputed election where the you know, debate about whether or not because of the old-fashioned way in which they basically punch holes in voting cards. There's a debate about whether cards were sufficiently indented. Weird as that sounds, but that's where it got to, and it went all the way to the Supreme Court. Al Gore eventually conceded, but what we do know is Trump is gearing up for a fight, because a lot of the voting this time around would be postal votes, and every state has different laws in terms of what's a valid postal vote and what's not. So there's a lot of scope for dispute if it ends up being a close result, and that's what markets are fearful of. The other scenario also is 2008, where the economy was weak, obviously still in the GFC, and was needing more fiscal stimulus, but we had an election and no one was in charge basically to deliver that stimulus. And it took until early 2009 before the last US fiscal stimulus package was passed, and that was when the markets eventually bottomed. The markets at the moment are crying out for another stimulus package for the US. It looked as if it was likely a few weeks ago. They failed to come to an agreement, and now that's been caught up in election politics and also the politics of you know, a new Supreme Court justice potentially, and that's going to suck air out of any potential possibility of a stimulus package in the near term. So that's you know, another reason why the markets at the moment are on the back foot. But again, I just leave with this central idea. Ultimately, we still remain in the hands of the virus. We are having a major second wave in many countries, but at this stage, they're avoiding lockdown because we haven't had the same extent of the spike in deaths and hospitalisation rates. And if that remains the case, then I think, you know, globally the recession is over. We are on a broad recovery path, and what we're seeing at the moment in terms of the equity markets is but a correction in this new evolving, you know, a bull market phase, I guess. I will leave it at that, and happy to take any specific questions if there's time.
Thank you, David. I really appreciate that. That was a a pretty quick run through a lot of pretty heavy stuff, and there's a lot going on in a lot of that. I wanted to kick off with a few questions, and guys, if you do have questions, just drop them in the chat box, and I'll be sure to ask David. Interestingly, the one thing that you didn't really talk anything about was housing in Australia. So I just thought I'd touch on that, because obviously all of us are very intertwined with the housing market. So what are your views on housing?
Look, I'm certainly not in the doomsday camp for housing. I mean, in terms of house prices, I mean, I think that, sideways to down, probably 5 to 10, but, on a 12-month view, I think that nationally house prices will decline by about probably 5 to 10%, not a lot, but nonetheless, a period of weakness. For the, it's in a mixed situation. I mean, we have very low interest rates. We have, but at the same token, we have high unemployment, but an unemployment rate that's coming down, and I think will basically continue to trend down. We don't have a big, massive building oversupply, and certainly the residential, sort of a standalone property market. So really, unless there's a lot of forced selling, and again, some people, and again, the one of the issues, of course, is with a lot of the debt forgiveness and the repayment holidays that the banks have put in place, they will be start to wind back. And so there will be some, people that probably decide they need to, can't afford the house that they've got and they will need to sell. But my base case is I don't think there will be, sufficient forced selling to cause a major further correction in the beyond, what I've said, 5 to 10% sort of correction in the market. Housing activity is another story. I mean, that, I think that's it. We're facing a period now of much lower immigration than we've been accustomed to. And I think that's going to, and that plus just the cyclical weakness that we're seeing is going to mean that housing activity is going to remain pretty subdued for the next year.
Okay, well, that's good. I mean, I don't know if you have a specific view on even the federal budget that's coming up. I think there's a lot of infrastructure support that may be coming through as well. I'm wondering if you might comment on that and if that'll underpin housing activity at all.
Well, in an indirect sense, I think it will. But I mean, I think what the federal government is going to be doing is basically offering states the ability to, give the states money to fund infrastructure, provided they spend it pretty quickly. The problem with infrastructure, of course, is a cyclical tool. Is that it can take a while. Certainly, if you've got no plans in place, that you've got the planning and organisation to build a major road or a new railway track or a power plant or something of that nature, does take a long time, several years. So, so I guess it'll be directed at so-called shovel-ready projects, things that are ready to go, and that'll differ across different states. So it's going to be, every state will be different in terms of how they spend that money. But indirectly, I guess it will be stimulus for the economy. But to what extent it direct? I mean, obviously there is the renovation program that the federal government announced. But look, my sense of that one, of course, is that it's been so tightly targeted. You've got to be prepared to spend a certain amount of money already. It's only, and if the house can't be worth beyond a certain value, there's actually not that many people that qualify for it at the end of the day. So it's a great headline, but it's not a huge boost to the economy.
Now, one of the things that you mentioning there were interest rates, and it looks like there's a possibility. I know a few other economists were talking about the RBA possibly lowering rates next month. Now, one of the biggest issues, of course, with banks is margin compression, and that impacts their ability to earn and, of course, to pay dividends and so forth. And I know some of the banks have either slashed their dividend or cut them entirely. Stephen Dinty's asking how you see the bank stocks in Australia performing going forward.
So just on interest rates, I'm actually in that camp that does think the RBA will cut next month. So I've had a view that I think ultimately they will be forced to cut interest rates Because the official cash, if you look at the actual cash rate trading in the financial market, it's actually trading at around 0.1, 0.15 already. So the rate that the RBA controls is the overnight lending rate that banks charge each other for excess cash. And because the banks are actually cashed up at the moment, they've got that much liquidity because of, households are actually cashed up from all the stimulus that's been directed their way, some of which they've spent, some of which they've saved. And banks have been just been flush with cash because all the monetary, the bond buying that the Reserve Bank's been doing. Anyway, so bottom line is that I think they can cut that cash rate. It won't have much effect. It'll be a headline, a sort of a jolt to confidence to do that. But I think they will do that. There's been some media reports just in the last couple of days suggesting the RBA may not want to do that. So it's maybe a little bit more debatable whether they'll go as early as next month. But I still think ultimately they'll probably take the rate down. And one of the reasons is I think they're starting to worry about the currency. They're worrying about the fact that other central banks are talking about, keeping rates very low for a very long time. And our interest rate is actually, would you believe it, relatively attractive compared to what you're seeing in other countries. Mm. But just in terms of bank stocks, look, in terms of relative performance, I mean, they've obviously been a drag on our market for several years because of the housing downturn, the compression of margins. And I think they're going to be, I think they're probably close to bottoming out in terms of their overall performance. I think our market is, close to bottoming out. We are in a recovery phase. So I don't see them as a bad buy, around these levels or on further weakness from here on an outright sense. But in terms of growth opportunities and, the dividend cuts, we've probably seen the worst of the dividend cuts as well. So from a yield perspective, they're certainly attractive and increasingly attractive given what the RBA is doing. But in terms of growth, I've long held this view that they're not going to be they're probably going to continue to underperform within our market. And given they're a big weight within our market, means our market will underperform global markets. Just we've got, a housing downturn, credit growth is going to remain quite weak. Their interest margins are going to be constrained. Their bad loan provisions are going to go up. They've made provisions already, but they're probably going to stay elevated for the next year or so. So fundamentally, it's not a case to be super bullish, but, we've had our downturn and I think markets are sort of bottoming out here.
So there you go, Steve. You might need to find another place to get that dividend income coming through. Just on that note, you talked about the bank stocks underperforming. Do you see any specific part of the Australian market or economy that will outperform in the next, say, 12 to 24 months?
Look, I think the beaten down COVID stocks are like the consumer, the retailers, the travel stocks, those sort of areas that have been beaten down. I mean, I think thinking forward a year, I mean, I think it's likely we'll get a vaccine. I think, we'll be past the crisis in a year's time. And some of those stocks haven't fully recovered. They're still well below, where they were. So those sort of the travel, retailing, beaten up stocks, some have recovered, but many haven't. I think it is a good sort of obvious source of outperformance on a sort of view that we'll get through this crisis eventually. Our tech sector, I mean, we do have some pockets of growth in our market. So we do have a very vibrant tech sector in Australia, albeit it's a relatively small part of our market. But the software as a service type, the Afterpays, the WiseTechs, these sort of companies, realestate.com. Car sales. I mean, these have been very vibrant growth stories, not just in Australia, but they're sort of growing overseas as well. Obviously, healthcare has been a big one here with the CSL and whatnot. They've continued to do well. Resources have had a very good run. Whether they can continue to outperform, I think iron ore prices are probably due to pull back somewhat, which probably will constrain their ability to get to outperform from here. But they've certainly had a good run. and probably relative to banks, I'd favour resources.
Okay, that's good. And of course, for those of you that didn't hear the intro that I quickly gave on David, he is the chief economist at BetaShares. They're an ETF exchange traded fund provider. And in fact, one of your funds has been doing really well, which is the ATEC, which is the Australian Technology Fund. For any of you who join us in these meetings that do a little bit of dabbling in the share market or manage yourself, manage super fund or whatever, that fund focuses specifically, and correct me if I'm wrong, David, but focuses specifically on Australian tech companies. And it has really been a cracking performer in the last 3-6 months or so. Is that a fair call?
Yeah, you're right. And obviously, there's one, Afterpay is included in that. So that's really helped that performance. But a lot of other stocks in there are also doing well. So it's as I said, it's a small part of our overall market. Technology globally has been the dominant sector in the last few years, has been outperforming. And the big reason we've underperformed is that our tech share of the market is so small. So what we've tried to do is at least deliver an easy way of getting access to that sort of pocket of growth within our market.
Yeah, and you've done it very well too. I wanted to circle back around to the resource thing, because I think China's economy, we really didn't talk about China at all either in your update, but China's economy seems to be really firing up here. And I'm just wondering if that's going to underpin resources and the demand for, all the stuff we dig out of the ground here in Australia and send overseas. Do you have any specific comments about that?
Yeah, look, I had China in that earlier PMI slide, just noting that it went into the downturn earlier than most back in January, February, whereas everyone else went into sort of March, April, and it has rebounded earlier than most. And so China, is almost back to normal in terms of overall levels of activity. What China has done in many other countries, we have provided support to the household sector. So we've provided a lot of income support, which has supported consumer spending. China have focused on supporting production. So it's where the levers they can pull are basically to encourage local governments, state-owned enterprises to engage in ever more infrastructure programs, housing developments, these sort of regional infrastructure, a bit like what this federal government's trying to do. So already that has really supported iron ore prices, and steel production in China has been bounced back very strongly, and iron ore prices are well over $100 a tonne. That had been partly due initially to the disruptions with Brazil. Brazil's been going through the coronavirus pretty badly, and it's disrupted some of their ability to supply. But Brazil's sort of getting back on board. But just the voracious demand out of China is keeping iron ore prices at pretty elevated levels. So, again, that's why our resources sector has had a pretty good run. And, should hold. I don't see iron ore prices pulling back in a big way. I mean, I think the federal budget have had them going back to $50 a tonne by year end. But, probably worse, I see them maybe going back under 100, maybe around $80, $90. Maybe not that far to $50, but certainly it's been a very good story for Australia. A little bit lost in the headlines, of course, because we're in a bit of a straight tit for, we wouldn't say tit for tat, it's all tat at the moment from China's side. Not tit for tat. We don't have many things to retaliate with, no. Apart from the Huawei restrictions. But the bigger story is in terms of those big areas like iron ore, China is, doing what it did during the GFC, essentially. Good.
Now, I've got a question from Peter Clark about global stocks looking a little bit more attractive than our local stocks. But really the question is, do you think the U.S. election is, who gets in is going to have a big impact maybe on the U.S. stock market? So if Biden wins, maybe what's the outcome? And then if Trump wins, what'll be the outcome?
Yeah, so there's two. I mean, also important with the election, of course, is not just who wins the presidency, but who gets control of the Senate. So I guess from a market's perspective, the worst case scenario, but also the scenario that the polls are favouring at the moment, although it's close, is that Biden wins the presidency and the Democrats get control of the Senate. So that's a clean sweep. Which means that corporate tax increases. I mean, part of the policy is to take back some of the corporate tax increases that Trump imposed. There'll be, concerns about regulation of the tech sector. Even, sort of breaking up some of the companies. I mean, these are the things that have been touted, and I think the markets will have concerns with that, at least in the initial aftermath of the election. Whether the Democrats ultimately go through with all of these things remains to be seen, but that will be, the market reaction would be a negative, I think, if the polls were to hold up. The best case scenario, again, politics aside, whether you like it or not, the best case scenario for markets, of course, would be a Trump victory and the Republicans retaining control of the Senate, because it would protect those tax cuts and it would reduce any risk of, serious regulation in areas of the US industry. The only issue with Trump, of course, is whether he would reinstigate the trade wars with China. I mean, the market's view is that he'd be more aggressive on creating tensions with China than Biden would. Now, it remains to be seen whether that will be the case, because I've long thought that the tensions with China have been a political tactic. I don't think ultimately he has been looking to do all that much. And we see it through the nature of the trade agreement that he did agree with China at the end of the day. It was pretty paper thin, wasn't that much very substantive. And even then, China hasn't really gone through with most of what it said it would do. Obviously, COVID has disrupted things a little bit. But I think if Trump were to win and he never would face re-election again, I think the political desire to, create tensions with China may well dissipate. So that's something to watch. So that's, how, and again, the other scenario is a Biden win and the Republicans are retaining control of the Senate, which would basically be a sort of gridlock situation. Would probably be the second best scenario, I guess, for the markets, ongoing Washington gridlock. But look, as I said, the polls at the moment suggest Biden is ahead and the Democrats are ahead at the Senate. Now, the only problem is the polls said Clinton was ahead 4 years ago and they got it terribly wrong.
Yeah, they sure did.
And one of the issues, and some of the pollsters say they've allowed for this already, but it remains to be seen, is that a lot of people that are going to vote for Donald Trump don't admit to it when they get asked by surveys. Whether they've resolved that bias or not is unclear.
Yeah, good. Now, I just wanted to, we got just a couple more minutes. You sort of went through with the economic, the shutdown. You showed us the charts where we just fell off a cliff. We've recovered from that as the economies around the world reopened. And I mean, my view at the moment is we're kind of not sure yet exactly what's just around the corner. Part of that is, of course, we've had the extended shutdown in Victoria, the closing of the borders of Queensland, Victoria. And I'm just curious, maybe if you could just close off by expressing to us any concerns, any big risks that you see to this extension of our economic recovery in Australia?
Well, I think obviously, the biggest risk is the COVID crunch. Victoria still in lockdown. What happens? The biggest risk is that a vaccine just proves, ever elusive. The markets are sort of counting on a vaccine being available later this year, early next year. You're getting mixed reports about whether that's going to be true or not. And this debate about, if in the absence of a vaccine, Victoria reopening up, what does it do if Victoria suddenly has 5 cases of COVID? Do they go into lockdown again? In the way, look at New Zealand, Auckland had a handful of cases and New Zealand locked down a whole city again. And so there's this massive debate going on globally about what is the best way to deal with this virus. Do we need an elimination hard line strategy where we lock down as soon as we get a sniff of this virus? Or do we, learn to live, quote unquote, with the virus as we're sort of doing in New South Wales and engage in social distancing, wear face masks to the extent we can, and hopefully, move along until, which keeps the economy, breathing at least until such time as we get a vaccine. So that's the biggest risk to me is we get another, upsurge in Victoria and they go back into lockdown again. Otherwise, well, obviously, if things get worse when the borders reopen, of course, we do face that risk. We're going to be mingling somewhat more, and that could cause a reinstigation of the travel bans and or some form of distancing. So we're definitely not out of the woods yet in terms of the virus. I think we are in terms of the reality. I think personally that it's proving to be not as bad as feared, and we can learn to live with the virus without going back into lockdown. But some governments, for whatever reasons, don't share that view, and that's the risk that we have a more doctrinaire approach to it.
Well, it's certainly going to be an ongoing, I like to call it a shit show. So it's going to be an ongoing shit show. David Bassanese of Beta Shares, Chief Economist at Beta Shares, thank you so much once again for sharing your insights, your incredible knowledge and depth and breadth of knowledge around the global economy, Australian economy. We look forward to having you back again, probably in the new year, to see how Christmas trading went and whether we're over the hump, as it were. Again, appreciate you taking the time to spend some time with us today. Thank you so much.
Okay, good to be with you all. Okay, bye-bye.
See ya. So guys, Gail Stevens, for those of you that don't know Gail, I think most of you probably should. I think she's a legend in the business, to be sure. A few years ago now, Gail, I can't remember how many years ago it was, probably 4 or 5. I think you knew this, but I can't remember. I sat in a program that you ran, and it was basically about re-engaging your own database and finding those nuggets of gold and those loans that sit right under your nose. And I think that's what you're going to be talking with us about today. So take it away.
Thanks, PJ, and good morning to everybody. It's really lovely to see there's so many people online, 90 plus people. I've been very excited about doing this presentation, and I hope you'll take away some good information with you. But just before we start, I need to share my screen. So I'll be just a few seconds while I do that. So stop chasing strangers. The gold is in your database. And of course, the gold represents the valuable clients that you've stored information about. I'd like you to sit back and remember the feeling when you settled your first loan and made that call to congratulate your clients. It's quite a milestone in your business, your first loan and your first client relationship that you created. Today is about continuing to call these clients regularly, particularly after the first year, when the calls seem to drop off, unfortunately, and they get taken over by the manual processes of using your database to send out emails, newsletters, 12-month health checks, etc. Personal calls do build stronger relationships, and strong relationships develop into lifelong opportunities for you and your clients, and I'm sure you will agree. As I was putting together my presentation, I actually ran off a report of all the people I'd met through the IFBF meetings. And it really made me realize how much a big part of my database belonged to IFBF contacts. So they are a large hunk of gold in my database. And here are a few happy picks. It has indeed been a privilege to meet, work and celebrate with IFBF members, particularly with those who participated and still support me with my coaching and mentoring programs. For those who have never attended a meeting until today, you would be very surprised at the large number of people from different areas of our industry, along with the majority of brokers that do attend. Today, I'm sure you'll be looking at this presentation and recognizing lots of external supporters of our industry as well. I've been looking around and I can see Zarko from the MFAA and Leah from the FBAA, who are always at our meetings. Several lenders and aggregator BDMs, including Yasmin Shah from Trade 24, who also looks after IFBF memberships, plus lots of sponsors, including Greg North and Alvin Lee, who have been in the IFBF since it started. And last but not least, have a look at the smiles on our chairman, PJ Space, and Stephen Dinty, our director. And I took these photos when we had a Christmas party a couple of years ago, and we were all having a great time. But back to the subject. Why should we concentrate on regularly calling the pieces of gold in our database? Why? Because these ongoing calls build trust and demonstrate your commitment to your clients. Most clients took up your offer to join them as a guide on their financial journey when you completed their first transaction. Often their needs have changed since that last call. And in these COVID times, it could be monthly that they need to hear from you. So your help is essential. What we have found in the programs is that after each conversation, 1 to 3 things will happen. That call will find out if their needs have changed. You also will be able to suggest some options. And then after you finish the call, you can follow up with the appropriate info, especially when you've discovered untapped opportunities. Regardless, most people are very happy to hear from you again, even if there's nothing to discover. And you will find that once you start a regular calling program. And yes, you'll also find that most of the clients are very happy that you have called them. And I put this up to show you what some of the results are when we do call clients during our 6-week calling period. So if you look at the top table of the slide, you'll see that there's results from 8 brokers. Now, these brokers belong to an aggregator, and they all were from different businesses. But most of them were only individual brokers, and a couple had admin assistants. They made in total 317 calls, and the responses they got were 317 happy responses. But I wanted to give you a really realistic idea of what your success will be with these calls. So I put in another table, and this was a small brokerage where there were 2 brokers and 3 admin people. One was training to be a broker. Now, they made 154 calls, and their responses of happy clients were 108 happy clients. And I included another column here. From the 154 calls, they had 51 appointments. So roughly 30% of their calls led to appointments. And remember, in both these examples, that these brokers had called clients who had not been spoken to for the last 2 years. But what really stops people scheduling regular calls? Fear of calling the first time, especially if it's a couple of years since they've actually spoken to them. And then time, and I realise how busy you are all at the moment. That's not very good English, is it? And I know that the processing times have really blown out because of the lender's decrease in risk. So they are 2 very relevant reasons why. Plus, being able to automate the processes in your software. Now, the aggregators are very good here. Most of these processes are automated, but you will find that you will have to do some of your own. And I know a lot of you use MailChimp, etc. But let's now look at fear. This is the first objection. And nearly everyone has a fear of making that first call, especially if they've not been contacted for 2+ years. And that's understandable. We work a lot on fear in our programs, and we discuss why we've said what we've said when we make the calls. And the reason for the fear hasn't changed. One of the most common responses I hear is, I will be so embarrassed if they do not remember me. So then I bring up this slide, which is a very simple slide of what's in the brain. Now you'll see that down the bottom, arrow 1 is the brain stem. And that's what controls your fight or flight reflex. Well, let's hope that your clients don't run out of the office when they first meet you, or that you don't want to continue. I know that happens a few times. It happened to me when I was a broker. But however, you start to talk to them and they start to talk to you, and you will both form a first impression about each other. And that first impression is stored in the limbic system, arrow 2. It's commonly called the dog brain because humans and mammals, especially dogs and cats and horses, never forget that feeling, that first time that they met you. And the last part of the brain, which is also interesting to hear about, is the neocortex, the monkey brain. Now, this is where your clients will remember most of the information that you spoke to them about when you first met them. But of course, that fades. I suppose the brain can't remember everything, but that actually fades in time. So it's another reason why regular calling can continue to educate and discover what your clients need. Now, the second objection that I hear is, I just don't have time to make calls. And the time you need for this process is approximately 4 to 5 hours per week, depending on the size of your database. But can you not afford to call? Because if you don't, you'll miss out on a lot of opportunities. Some examples: saving your clients money, uncovering untapped opportunities, untapped needs that they may have never spoken to you about, and those which have changed over time. Maybe they'll give you some referrals, or maybe they'll mention someone that would be a good referrer for you. There's so many things that get uncovered in short calls, regular calls to your clients. Unfortunately, though, when you call, it's inevitable that a few clients will have gone to somebody else, either a lender or another broker. And that may be just because you haven't rung them very often. And the response might be, "Oh, I'm really sorry, John. Since you put me with XYZ Bank, I just thought it would be better to go directly to them and don't bother you." Well, we know what that really means. However, if you do have a large database, a part-time assistant is a good idea. This person can make the calls for you and pass on the opportunities they discover, as well as being a second person that clients can ring when you're out on appointments or processing your loans. And I may have an opportunity here today. Maybe you need a Helen or Ken on your team. At the moment, I have 2 excellent people to recommend, and probably every month I hear of people looking for this type of work. In the Parramatta and Hills area, if your office is located there, I can highly recommend our lovely Helen, who has worked for Qantas for over 20 years. looking after their travellers. And, I might add, also managing to do 1 day per week for Meals on Wheels. And I've put a picture up here of Helen coming along to deliver Dad's Meals on Wheels for the week. And it was actually his 90th birthday. She was our angel, I can tell you. And then I have to mention broker Ken, who lives in the Lake Macquarie, Newcastle area. He was one of my brokers when I was at Plan Australia. A true gentleman, and like Helen, is a terrific customer service person. All his clients loved him, and now he's partially retired and looking for a few days per week to help a broker who has too much work to do. Email me or SMS me and I can put you in contact with either of them, or just let me know if you are looking for someone, and I'm happy to look out for someone for you. That they all will be people that I know will do a good job. These calls from even your part-time assistants will complement your processes in your database. So now I'm going to put up a slide that will look at the advantages and disadvantages of your CRM software. Now, your database is a very essential tool for everything you do in your business. But the one thing it still cannot do is call your clients. So let's look at the advantages and disadvantages. The advantages, it can be programmed to send out emails, confirmations, newsletters, and of course it stores all the information on your clients within its hard drive, including the commission and trail details. Aggregators do a great job to support this CRM software, but the biggest disadvantage is that your database cannot speak to your clients and uncover their problems and offer solutions. So it's one of those tools that we need and we can't do without, but we have to be a little bit more creative with how we look after our clients. So how well do you know how your database operates? Creating an ongoing contact process in your database is pretty simple for whatever CRM system you use. However, do you really use it for these tasks? Step one is to explore your CRM database fully. And who better to ask questions of than your aggregator BDM or their technical department or their help menu that comes with every piece of software. However, the most important fields to be able to complete so that you can speak to your clients are the following: notes, tasks, and reports. All essential parts of your process. And the information you record in these 3 fields needs to be backed up in your database. So make sure you back up monthly without fail and set a task to do that. Now, because the people who have done my programs will tell you that I always have a call to action when they are part of my programs. So today I'm going to give you a challenge so you can put what we have spoken about today into practice. And that challenge is, by next week, Monday the 28th of September, I'm going to ask you to call 2 clients who you have not spoken to for 1 to 2 years. Record their response and then send me an email detailing how the call went, using first names only and not mentioning anything about the amount or where they had their lending. The first 10 people who email me will receive a free 15-minute mentoring call from myself, and I'll help you with anything you need to know about this program. Now let's look at some results you can expect from your calls. You saw this slide before, and we went through how many good, happy responses you received from the calls that you were making. On average, you would expect to have about a 70% happy client response rate. And with your appointments from these calls, a 30% is a very good result. Between 25 to 30% is the usual response that we have when brokers call their clients. Now let's drill further into these average results produced by people who attended my Untapped Clients program and achieved similar results. This slide is the full version of the 8 brokers that completed my trial in February and April 2018. Now, if you look to the conversion rate, you'll see that it varied between the highest, 46%, to the lowest, 19%. And the amount of applications taken were $15.7 million worth of business. And the potential loans totaled $6.9 million. And all those potential loans that they listed were loans that they were only waiting on a little bit more information before they could submit. So they were very, very good results. And the aggregator they worked with was very pleased. I think they got a 200% return on investment because they sponsored half of their fees. Now, I also thought I'd put in how much they actually earned. Well, I don't know exactly how much they earned, but I based it on the broker upfront and broker trail that ASIC used in their Royal Commission. So for the person who, the top broker here, broker 1, who submitted $4 million worth of applications, he received $21,600 in upfronts, and over the next 12 months would expect to receive $5,600. Altogether, $27,200. A pretty good earning from 6 weeks' work in calling their clients. All had different experiences, but everybody basically, like I said, has an average of between $2,000 and $4,000. $4 million, sorry. Got to get my facts straight. So now I'll give you another example. These results were from the brokerage that I spoke about before. And when we look at their call to appointment conversion, it was 33%. And between them, they took applications of nearly $32 million and $7.8 million estimated sales over the next 6 to 12 months. Again, they were very, very happy. And the average sale per broker was $5.32 thousand. Pretty good result. Actually, I'm just looking at that now. It was $5.3 million average per broker. How could I make that mistake? So let's move on to this slide. Now, these are my most recent results. My last 2 programs, Untapped programs, were in June 2020. And the 2 businesses had single brokers, and one had an admin person helping them, and the other business had a VA, so that was someone that wasn't in their office with them. And the first business, as you can see, got $5.3 million worth of lodgements and $5.2 million worth of loans due to settle in 3 to 6 months. And the second business, $1.9 million worth of lodgements and $2.5 million coming to them in 3 to 6 months. So I was really pleased, and they, of course, were over the moon with their results. And I've got to say that business one was very reluctant to do the program, but was pushed by one of my referrals and was so happy that they did. Now, what are some incentives I can give you, especially for IFBF members and non-members who have watched my presentation? For the IFBF members, the first incentive is, if you email me Monday, sorry, the first 5 people email me on Monday with their results, they will receive a 30% discount on my Untapped Clients program. And that starts on the 27th of October. And each program, whether it's my referrer program or my Untapped Clients program, involves a workshop, a 6-hour workshop, and 6 weeks of individual mentoring where you put into practice the process in your database and making those calls. Incentive 2 for IFBF members is the same 30% discount, but this time for people who've already done my Untapped Clients program and would like to go through my Untapped Referrers program. And that starts on the 5th of November. And for all, last but not least, all non-members of IFBF who have listened to this section, I'm offering all of you 15% discount. Now remember, I have a maximum of 9 people due to the COVID restrictions who can attend each program. If you're interested in either of these 2 courses, please send me an email, and if there are any spare spots, I'll let you know. And now I'd like to leave you with this summary. It's a good summation of what we've been talking about. All the people in this diagram, including yourself, need regular conversations, especially to thrive and survive in this current environment. And the clients in your team, internal and external teams, need you, their broker. Remember, you are their guide along their financial journey. And I wish you all the best for the future. Back to you, PJ.
Guys, thank you very much. Gail, I should say, sorry, not guys. Gail, thank you so much for running us through that. And again, everyone, please do, take advantage of that opportunity. You will not be disappointed in doing so. Okay, now I am very, very excited to have Fabian DeMarco present to us. Last meeting, I asked everyone about development finance. Now, Fabian's going to tell us all about this, but I reckon with all the stuff that is coming down the pike for Australia in the next 12, 18, 24 months, in light of what David Bassanese has told us about our recovery, I think there's going to be some huge opportunities, particularly in this niche space. Now, many of us don't know a lot about it. There's over 250 private lenders in Australia, and I can speak from personal experience, they ain't all legit. And so the minefield of this space can be navigated well if you have the right partner. And so Fabian and I have been working together, and that's why I'm very pleased to have him join us to tell us all about development finance and that space.
Thanks, PJ. I'm just going to share my screen. Okay, so can everyone see that?
Yes.
Great. All right, so look, guys, very quickly, I'm going to try and keep things pretty high level today. I know you've had a lot of information thrown at you, and I know that it can be a bit overwhelming sometimes. So I'm going to try to keep this pretty high level. So look, I want to just kick things off with a quote that I really, really like. And I think it's quite fitting for what we're doing here today. So, you know, sometimes it's a bit of a decision for brokers as to how much time they take out of their day to focus on personal development and things like that. So it's a quote by Abraham Lincoln that basically says if he had 6 hours to chop down a tree, he'd spend the first 4 sharpening the axe. So I think what you're doing today by attending this forum or this Zoom meeting is sharpening your axe. So so hats off to everyone for taking some time out. I hope when you leave here at the end of this, you certainly feel as if you've had an opportunity to sharpen your axe, so to speak. So look, let's get into it. Let's start with the big idea. So what is the big idea? This is something that I picked up from an author called Oren Clough. I don't know if you may have heard of him, but he's probably responsible for writing one of the most well-known books in the sales and influence space called Pitch Anything. But the big idea is basically a very punchy snapshot of basically what it is that you're trying to get across, your message. So guys, in the private funding space, as PJ already alluded to, it's a very, very unknown space for some brokers. So guys, there's probably over 200 private lenders in the market at the moment. Knowing which ones that you can trust, which ones that you can deal with, which ones have certain inklings towards certain types of transactions, what are their LVR restrictions, what are their maximum loan amounts. All of this can be quite a daunting task. There's no sort of database you can go to that has all of these lenders and has all of their, I suppose, all their metrics on there. So attempting to try and find the right lender for the right deal can be quite overwhelming. So if you don't have the right sort of experience, if you don't have the right sort of knowledge in this space, you could potentially find yourself in a position where the borrowers can lose significant money up front. And more importantly, as a broker, you potentially risk damaging a relationship that maybe you've invested years building. So it's quite a daunting space. So what I'm going to try to do is shed some light on the space today. Give you some high-level overview on development finance and private funding in general. And at the end of this, hopefully you'll walk out feeling a little bit more confident about the space. So let's get started, guys. So firstly, in the private space, there are, or in commercial lending in general, there's typically 3 tiers of lending. So these are not hard and fast, but generically there's 3 tiers. You've got your banks, which many brokers will be quite familiar with using. So there's just a couple examples there of some of the lenders that would be in that bank category. You've got your non-banks that lenders like ING, Suncorp, Latrobe, those types of lenders would fit in that non-bank space. And then you've got the private space, guys. So the private space is typically mortgage funds, family offices, you've got credit funds, there's high net worth investors in there. So a whole range of, I suppose, unregulated entities that operate in that space. So as most brokers would be quite familiar dealing with the first 2 tiers, the 3rd tier is where it gets a little bit unfamiliar for brokers. So the first question a lot of people usually have is, where does this money come from in the private space? Where is it coming from? Who's funding these loans? And that's a very fair question that you'd want to know, and you'd probably want to be able to inform your clients on as well. So typically banks would generate their money for loans either via the bank deposits that they received, and also global money markets. They go out into global money markets and through securitization, they raise money. Non-banks are fairly similar to banks, although that they don't tend to have the deposits to draw on. They may have a large institutional funding line, a warehouse facility, and also they raise money in the global markets as well. Now, the private side is a little bit different. So the bulk of loans in the private lending space is basically funded by high net worth investors. So these are investors that have a stack of cash. They usually fit what they call a sophisticated investor category. So they need to qualify for that. And they've got a stack of cash, and there could be a large super fund. They could be just a high net worth individual that's got a ton of money that is not feeling too inclined to want to put it in a term deposit at the moment. because the returns are quite low. So they think, let me find a mortgage fund that I can invest this money in. They'll lend it out for me. I know that it's secured against the property, and they'll take a return. So the bulk of these mortgage funds are funded by these investors. Now, they could be individuals, they could be corporations, they could be super funds, they could be other lending institutions that are looking to just fund into other mortgage funds. So it's a combination of different sources. Now, one of the questions I get asked quite regularly is, how can private funding help? What is the difference between private funding and bank funding? The first thing you need to understand, and the first thing I would always convey to a client, is that a private funding solution is just that. It's a solution to a problem that can't be solved in the mainstream lending criteria. So for whatever reason, if you can't get a deal placed or set in the normal lending parameters, so with a lender typically on a aggregator's panel, then it has to go into a private space. There is no comparison. So you would never, not in a million years, have a loan offer on your desk from a lender in a T1 or T2 category, and you would go and compare it to a private lender and try and compare it as apples for apples, because it's never going to compare on price. It's never going to compare on fees. So the only time you'd find yourself in the private space is if you need a solution that can't be obtained in your mainstream lending space. Now, I'll run through very quickly just some of these. I'm not going to go through everything, but high level, you've got credit. If someone's having some issues on their credit, they may not be able to get approved in a mainstream lending space. Private lending is much more flexible on bad credit history. Typically, there's no serviceability required in the private space. Now, the one thing I will say in the private space, lenders typically only operate in non-coded loans. So when I say there's no serviceability, if you've got a mum and dad who's buying an investment property, but for whatever reason can't meet bank serviceability, that's not a good, I suppose, scenario that would fit in the private space just because they can't meet servicing, because that would still fall under a coded loan. So when we say non-coded loans, we're looking at loans that are for business purposes that have a company as a borrower. Timing, things move a lot faster in the private space. You could have a settlement that could be facilitated potentially in 48 hours. I'm talking about application to settlement in 48 hours. So things like that can happen quite quickly. Credit assessment responses. I've heard some horror stories at the moment on some of the turnaround times that is happening in the typical home loan space. In the private space for these commercial loans, you could have a credit assessment the same day, a conditional approval issued the same day. So things move very quickly. Flexibility is a big one in the private space. So guys, your rates can be quite negotiable depending on the risk level in the transaction. Now, risk level is things like your LVRs. Low LVRs, you can negotiate a better rate. There's flexibility around loan terms. Now, typical everything in the private space is 1 to 3 years, but you can be flexible. You could have a 6-month term, 12-month, 24. It's quite flexible depending on what the need is that you have. Around construction stuff, typically in a T1 or T2 bank sort of construction lending scenario, the lender is going to insist on having pre-sales, usually equal to the amount of debt that you have. Now, in the private space, there's plenty of lenders that will facilitate a construction loan with no pre-sales. So this enables a developer essentially to get building straight away. Whereas if they were under a condition where they needed to achieve, 10 pre-sales in a block of 30 units, those 10 pre-sales could potentially take them 6 months to facilitate. In the private space, they would be able to commence building virtually straight away. And more than likely, the extra cost that would be involved in the private lending could potentially be made up in the sale at the end of the project. So things are, as I mentioned, are quite negotiable. So there's a lot of things in the private space that are very, very attractive if you can't meet criteria in the normal lending space. So I'm just going to jump ahead to a couple of comparisons. So this is where I think people will find it a little bit more interesting. So typically there's two types of loans that would fit in a private space, and in particular in development finance. So you've got land purchasing. So now when I say land, it's typically the development site, or it could be even a residential property, it could be a commercial property, but typically anything that has, there's no construction element to it. So it's literally the asset you're purchasing. Now, whether that's to be a future development site or just an asset you're buying, typically in the bank, you guys can have a look at that. Typically on a development site, a bank is only going to extend up to 50%. In the private space, you could potentially be looking at 65%. So higher leverage. The rates in a bank or a non-bank environment would probably on a development site potentially fluctuate between 4 and 7. I think 7's on the higher side, but potentially somewhere in that range. In the private space, rates have probably come off a little bit in the last week or two. I'd say potentially now, between 6.5 up to anywhere up to 11, 12%. So it's quite a wide range, as I said, and a lot of it is dependent upon location, the loan to value ratio, and the strength of the exit position. Timeframes comparing the two, typically in a bank, 6 to 8 weeks, I think is potentially being generous. In the private space, it could be anywhere from 2 days to 2 weeks. So it can vary quite a bit between the two options. Interest, this is probably the one that is probably most appealing to developers that go into the private space. In a bank environment or even a non-bank environment, you have to demonstrate serviceability if you're going to purchase something. In the private space, there's no requirement to demonstrate serviceability because they essentially typically capitalize the interest into the loan. So for example, if you're buying a development site, let's say you're taking a 12-month facility, the lender in the private space will say, let's take 12 months worth of interest. We deduct it from the gross loan amount, and it's already essentially prepaid for the full facility. So there's no need to make any monthly repayments. Everything's pretty much done from day one. So let's have a look at construction finance now. So look, guys, as I said, I'm running over this stuff a little bit quicker today, just to give you a high level understanding. I'll be free to have a chat anytime if anyone wants to reach out to me and get a bit more in depth into some of this stuff. Typically in construction, and I'll talk about this a bit more when we get to loan to value ratios, but in construction, there are two LVRs that a lender will typically look at. One is an LVR against the sales, so the end value of the project. So if you think of this as just a normal building loan that you would do in a residential channel with a bank, the as if complete value of the project. So that's one LVR. The second is an LVR against the total amount of costs. So the total amount of costs in a development, if you think of a profit and loss statement, the total amount of development costs would fall under the costs in your profit and loss statement. So all of those costs, you tally them up from the land purchase price to the stamp duty to the construction costs to contingency to loan interest and everything in between, marketing. You add all of that up, and a lender will typically only want to advance between 75 and 80% of that amount as well. Now, out of those two LVRs, the one against the costs sometimes is a little bit more flexible in the private space. The one against the sales, the as if complete value, is a little bit more hard and fast. So typically in a bank, as you can see, you'd probably cap out at 65%. In the private space, it's pretty much the same. However, there are some privates who will go to 70 on the as if complete value. Against costs in the bank, they typically cap out at around the 75% mark. In the private space, it's 80%. Some will go up to 90% as well, depending on the project. Rates, as you can see, similar to the land, you're looking at 3 to 4% in the construction space, some even lower depending on the project. In the private space, it's between that 5 to 8% range. A line fee, guys, line fee is typically charged on the facility limit, whereas the rate is charged on the balance as it draws down. Line fees in the bank are between 1 and 2%. In the private space, potentially between 2 and 3. So the pre-sales is probably why most people come to private as opposed to bank funding. So we work with some developers that they could probably qualify for bank funding if they wanted to. However, due to the pre-sales requirements, they choose to go private because they prefer to just get started right away. So as I mentioned, in the private space, you could potentially get started with no pre-sales. Some, if they want sharper pricing, will go for a small 30% debt cover. But as I said, it's very flexible in the private space. In the bank space, you pretty much need 100% debt cover to get approval for construction finance. Now, there are some banks that will be negotiable on that. If you were to bring down your loan to value ratio, for example, to 45 or 50%, but that would mean you would obviously have to put in a lot more of your own capital as a developer into the project up front. And again, settlement timeframes, is a big difference as well. So guys, look, I've got some development finance jargon stuff here, which I'm not going to go through everything. What I'm probably going to do is just touch on 2 or 3 of the main ones, so that you may have heard these words like GRV mentioned before. So what GRV is the gross realization value. So that's a fancy technical term for as if complete value. So essentially when a lender asks what is the GRV of the project, what they're really asking you is, when this thing is built and finished, what is the total value of the stock, the units, the houses, whatever it is that they're building. Now, this figure can be quoted 2 ways. One is inclusive of GRV, of GST. The other is exclusive of GST. So when a lender looks at their maximum loan to value ratio, they are always looking at it exclusive of GST. So when a valuer values the property, they will give 2 values. They will give the value including GST and the value excluding GST. The lender is going to adopt the figure that is excluding GST. And the other one is the TDC or the TDCR. That is essentially that LVR we spoke about, that is against costs. So that if someone is saying, what is the TDCR or what is the TDC? That is, they're asking you, what is the LVR against the total amount of costs? So how much is the loan represented against the total amount of costs? What is that a percentage? And debt cover, look, we've covered that as well. Look, I'm happy to share some documents on all of this stuff and email it around to PJ, who can share it out with everyone. So you can probably sit down in your own time and sort of just go through this stuff. The other thing you might hear mentioned a little bit is senior and mezz. I know that's senior debt and mezzanine funding is a question we get asked sometimes. What does that mean? So look, senior debt basically means it's another word for first mortgage. So the senior debt is the first mortgage holder. So whoever's providing the bulk of the debt, and when I say the bulk of the debt, sometimes in construction finance, a developer will also get a second mortgage behind to cover up some of the shortfall they may have. And that second mortgage is referred to as mezz funding or mezzanine funding. So if ever you're hearing these terms, senior debt, mezz funding, the quickest way and easiest way to remember, senior debt is your first mortgage, mezz funding is your second mortgage behind it. So as I said, I'll just touch on some important LVRs that in the construction space and development finance space that you might hear. And I've mentioned GRV excluding GST. Typically in the private space, you're looking at anywhere between 55% and 65%. So I know it's a wide range. What determines whether it's 55 versus 65 would be the location of the development site or the project, the strength of the developer. Have they got a lot of experience? Is there any pre-sales on the project? What is their balance sheet? What does their assets and liabilities look like? So depending on how much you can tick all those boxes and create a good case forward will depend on how much the lender would be prepared to increase that loan to value ratio. Again, as we've mentioned, the TDC or TDCR is that LVR against the costs. And as I mentioned, it typically cuts at 80% in the development space, but some lenders will look at going up to 80% with that second mortgage behind that mezzanine funding. And again, same thing on the land site value. So this is the value of the site as it is. So lenders will want to know when they do a project, how much is the land worth as it is, and how much is it worth when it's being finished being built. So guys, I'm going to just talk quickly about funding tables. So funding tables are very important because a funding table, in particular on a land transaction when someone is buying a site, so there's no construction involved at this stage. They're just looking at purchasing a site or a property. Typically what happens is you start with what they call a gross loan amount. So that's your maximum loan amount. So if we say it's a 65%, they'll start, okay, this is your gross loan amount is 2.5 million. And then what they do is they deduct the loan fees, any interest that is going to be capitalized, and then you get left with a net figure. Now, the funding table is important to show to a borrower because it helps them understand exactly how much money they're going to get left with in their hand at the end of the transaction. And that's really what they want to know. The gross loan amount is what needs to get paid back, but the net loan amount is what they're going to get left in their hand. So you can have a look and see how it typically breaks down. Same on a construction one, this is a funding table that will give you an understanding on how a funder basically will put together how much is going to be as a loan and how much the developer is going to have to put in out of their own pocket. So typically you can have a look in the first column, you've got the total costs for a project. So these will involve the land cost, acquisition is like stamp duty, the construction costs, including the contingency, marketing, professional, all of the different costs that are involved. So, and you'll get a total here. So this is a total that it's going to cost to build the project. Then you'll have two columns. Sorry if I look like I'm pointing at my screen, but it looks like I'm just waving my hands around in front of everyone. So please excuse that. So you'll have two columns. You'll have an equity column and a loan column. So typically this is where we'll work out how much the lender is going to fund out of this construction project and how much the developer is going to put in out of their money. So typically a lender will fund whatever loan is on the land. They're either refinancing that, or if you're purchasing it, they'll fund that component up to the maximum loan amount. They'll typically always want to fund the construction cost and the contingency, plus the interest, obviously, and loan fees. Usually once you get to that point, you're pretty much capped out to the maximum LVR anyway, which typically means that the developer has to put in the rest in their equity column. But if there is still room, if it's a project that's got quite a lot of room in the LVR still, then you are then also able to think about, including some of the marketing costs or the consultant fees into the loan as well. But this is a moving table that can sort of be flexible and constantly updated as you go, depending on the valuation where everything sits once that's completed. So guys, I know a lot of this is probably system overload, and I've tried to cram probably what should be a whole day worth of information into 20 minutes. So I apologize in advance if your head's exploding at the moment. As I said, happy to take any questions offline from anyone that wants to sort of delve a little more into this space. Look, some of the things that we can potentially help you with is in the private space, typically anything that's commercial property that is, as I said, non-coded. That includes residential property as well, that are being purchased in company names. Residual stock loans, which is basically a developer who's finished building a project and now they've got 10 units that they need to pay out a construction loan, so they need to take those 10 units out. Land banking, which is basically the purchase of development sites. Construction loans, and also second mortgage and caveat loans. All of those sort of things would fit within that private space. So guys, look, lastly, I'm not really here. I don't want to try to just pitch what we do. It's more about just giving you some overview on development finance. But look, if someone wanted to ask, why would someone use a partner like us to get their private loans placed and settled? I'm well aware that a lot of brokers on this Zoom meeting right now are more than capable of finding a private funder and taking a transaction to them. And, we encourage you to try that. However, if you're looking for a partner that you could trust, that you're looking for someone that you can just say, here, this is your domain, you guys do it. I know you'll keep me involved, and I know that you guys know what you're doing. That's why a broker would use us. They don't come to us because we basically are the biggest players in town, or we settle the most deals, or we guarantee you the sharpest rate. They come to us because they trust us, and they see us as a valued partner. So that's not going to be everyone. We're well aware of that. But yeah, if you're looking for a partner that you can sort of work alongside, we try to mentor brokers a little bit as well in this space as we go along through deals. Then give us a shout, and we're happy to talk through. Lastly, guys, look, that's our contact details, which I'll also pass around to PJ. The business is made up of myself and my brother, so we're a family business. My brother typically looks after all of the front end of the business, and I typically look after the back end in placing the deals and getting them set. That's it, guys. I hope you've enjoyed it. PJ, I want to make sure I don't hang this up. So do I just
thank you, Fabian.
Yeah,
just click on the three dots in my picture and make me the host again. Guys, we are a little bit over time, but I would be happy to hit Fabian with some questions if you do have any, just while you're maybe typing some in. I've got to say, I've been working with Fabian, I don't know, probably for about 6 months or so. He was introduced to me by Yasmin, who worked with him when he was, and he didn't mention this, of course, but when he was with the big bad bank. It's come out of the banking sector. But I've got to say, this is a very special area of finance. Development finance is not for, just the faint of heart. It is very much a minefield. I've learned the hard way about that. I'm happy to tell you that story at some other time. You can buy me a beer, maybe at the Christmas party, but it was a serious F up. And Fabian stepped in and really did help me out a lot, educated me as well. So he is a fantastic partner in his business as well, would be a fantastic partner for this space. For most brokers, it's not our high priority. We get these deals maybe once every year, couple of years, unless you dwell in that space, obviously. But just know he's a fantastic dude, and he's absolutely someone you can trust. So any questions? Here we go. Adrian's asking, what should we look for regarding the Cowboys? So what are some warning signs, Fabian, that you might be dealing with a shonky outfit?
Look, typically a warning sign would be a large, hefty upfront fee, non-refundable. So when I say large, hefty upfront fees, I'm talking like, if you get a term sheet from a lender that wants $10,000 upfront, non-refundable, that would be a warning sign. Unless it's $100 million deal or a $50 million deal, but typically your standard deal, a couple of mil, 2, 3, 4 million, 10,000 upfront could be. I'm not saying that all lenders are like that, but typically large upfronts, like small upfronts, few thousand, that can be quite standard for the private space. But anything in that 5-digit number, that's a bit of a red flag. I wouldn't say that whoever you're dealing with is doing something wrong if they do that. There are some lenders that are legit that do have high upfronts, but I'd just be wary and make sure that you do a bit of due diligence on the lender before you get anyone to pay anything.
Excellent. Or you can just call Fabian and say, are these guys dodgy or not? I mean, that's probably the first thing I would do. And look, I think this space too, guys, for those of you, because, look, we're all resi and commercial sort of brokers, and we deal with really good clients, and we're used to low interest rates and all that sort of thing. So Fabian said it at the beginning of his presentation, he provides a solution, and it's not rate focused. So if and when you get these development deals that can't be set with a bank and you call Fabian, just forget about rate. It has nothing to do with rate at that point. It is about how you provide a solution to your client and get a deal done and hopefully help them make some money. Any other questions? It looks like we're out of questions. Guys, thanks again to all of our sponsors who have stuck with us. We'll have to hit you up next month and give you a few minutes in the beginning of the meeting to touch base with us and give us an update. We have run a little bit over time today, but I think you'll all agree we've had some jam-packed, awesome information today. Just a reminder, Christmas party, 27th of November. Put it in your calendar. Stay tuned for information coming out on that. For those of you that have joined us for the first time at the IFBF Zoom call, you do get CPD points for this, and it's at the top of the agenda. So the codes for the FBAA and the MFAA are at the top of the agenda. It's a self, certification process. You'd say you were here. If you get audited by somebody, we'll have to try and prove you were here. But in any case, you've got those. And then finally, our next meeting is the 30th of October. It'll be the last official meeting where we've got, content and so forth like this. And then we'll, of course, have our Christmas party coming up. So everyone have an awesome weekend. Looks like it's going to be a nice one. Beginning of school holidays. I don't know where we're all going to go. I guess we're just going to have a holiday at home, maybe a tent in the backyard or something. But anyway, guys, thanks again. Everyone have a wonderful weekend. We'll see you next month. Cheers, everybody. Bye-bye.
Thanks, PJ. Bye.